Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and we have an excellent program today. I always look forward to the tax programs at the end of the year. A couple of comments. We are in need of volunteers to help us in the areas of running the program. Even though Zoom meetings in some ways are simpler, there's a lot of activities in terms of recruiting speakers, publicity, managing web pages, video editing that requires help. So if any of you would like to help, please let us know on the chapter email address, and we'll get back to you. It's a pleasure to welcome Russell Barnett. He's spoken to us before, does an excellent job, and knows taxes really well. Russell is an enrolled agent and a certified tax strategist with more than 18 years of experience. And is the CEO of the Silicon Valley chapter, Silicon Valley Tax Coach in San Jose, California. They provide comprehensive tax and accounting compliance services for small businesses and individuals, as well as proactive tax planning for business owners and investors to legally reduce the amount of money they pay in taxes. They've saved more than $6 million to their clients over the last 4 years. So with that, we'll turn the time over to Russell and our tax program today. Thank you.
I have to update that figure at the end there. I just did a recent recalculation, or actually about $9.5 million saved. So we had a good year this year. So, and our clients had a good year anyways. So anyways, thank you for having me on. I'm a pleasure to share this information with you. This is, we can only go over so much in a 2-hour period. So my goal today is to give a quick overview of some of the changes for this year, and then talk about some kind of concepts that you might need as we approach the end of the year. Once we get past December 31st, there's not much we can do to lower your tax bill, but there might still be some things to do between now and the end of the year. So we'll talk about that, what you need to do, what you need to be aware of, some things that you might want to think about. So I generally will just answer questions as we go. So please do put them in the chat as was mentioned. We do have a lot of people here, so we're not going to be able to address verbal questions, but we will try to answer them as we go in the chat. So if I don't get to you right away, please be patient. I do have some moderators who are trying to help make sure that I don't miss something, but depending on where my attention is, I may or may not catch something immediately. So I guess without further ado, I'm going to go ahead and get started. So thanks for joining us today. So again, this is a general overview of what I'm talking about. We're going to look at some things that might be coming up next year, some things that you might need to be aware of this year. The IRA stands for the Inflation Reduction Act of 2022, which is the major piece of tax legislation that was passed this year. Had a couple interesting things that was enacted in August of 2022. We're going to go over the withholding and estimated payments rules, so we can understand what your obligations are and how to avoid underpayment penalties, what causes them to be assessed, and again, how to avoid them. We're going to look at some general capital gain year-end strategies, and then some other year-end tax issues. So we have kind of a lot to go over. So we're not going to spend a lot of time going into detail on any one thing. If something I'm talking about piques your interest, please feel free to put a question in the chat. You can always reach out to me afterwards as well if you have other questions. The last slide will have my contact information, but I'm sure also that the chapter has published it. So anyways, so let's just jump right into it. So 2023 is about to start, and we have a couple changes to your standard deductions are going up a bit due to inflation. The Social Security cost of living adjustment has been published at 8.7%. Also due to inflation, that's a pretty large increase. And for most people, Medicare Part B premiums are going down. Is what I found. So the limits for retirement accounts are actually going up. This year in 2022, the limit for your 401k is $20,500. That's increasing by $2,000 to $22,500. The IRA limitation contribution is going up from $6,000 to $6,500. So that's also increasing. So, and then the gift tax exemption increasing from $16,000 per person per year to $17,000 per person per year. And just really briefly, we have an estate tax in this country with for people that die with a lot of wealth. Right now, the exemption from that is about $12 million, right? So each person can die with up to $12 million in net worth and not pay any estate tax. Gift tax is a mechanism put into place to prevent wealthy people from just giving their money away before they die to avoid estate tax. And so the gift tax exemption and estate tax exemption is one unified credit, and you can give up to $17,000 to any one person or as many people as you wish, but up to $17,000 per individual per year without having to worry about using up any of that exemption. So for the vast majority of people who don't give that large of a gift during the year, that's never an issue, and that's how it's designed. So, but that limit is increasing from $16,000 to $17,000, meaning that for a married couple, you can give away up to $34,000 to any individual. If they're married, you can give away up to $68,000 and not have to worry about filing gift tax returns or using up any of your lifetime exemption. So we do have a lot of these limits moving up this year due to inflation. So in 2022 items, just to be aware of some of the deadlines. This year, the 2022 individual tax returns are due by April 18th because the 15th is Saturday, and Monday, the 17th, is a holiday in some states. So they conspire to make sure that I work 3 extra days again. So, but you have a little bit extra time to get things done and get your payments in. HSA and IRA contributions for 2022 are also due by that date. You can file an extension up until October 16th of 2023, but penalties and interest will apply for any tax paid after April 18th, even if you file an extension. So as always, the extension gives you additional time to file. It does not give you additional time to pay. And then for business tax returns, entities such as partnerships and S corporations are mostly due by March 15th. Your SEP, IRA, and solo 401k and other employer sponsored retirement plans are also due by the due date, including extensions. An extension for 6 months would give you until September 15th, 2023. And I have a note here to keep basis in mind. If you own a partnership or an S corporation, you're probably aware of this, but you can't take out more than your basis without having a tax. So I'm not going to, this presentation is geared towards individuals, so I'm not going to go into depth in that. If you have a question about it, please speak up or contact me separately. So I'm sure, this crowd, you're always well aware of these I-bonds. I just found them interesting because they've been such a popular topic this year, given that up until the end of October, they were paying about 9% interest, right? And the interest rate reset and went down a bit in November. And the US Treasury sold $7 billion of I-bonds in October 2022, which is $2 billion more than they sold in all of 2021. So people were rushing in to get their that high interest rate for the first 6 months that they owned the bond. It's now down around 6%. I don't remember the exact amount. 6.89%. It's on my slide. So, but you can only buy $10,000 per year per tax ID number, meaning that each individual can purchase up to $10,000 per year. You can purchase them as a gift for others, but it counts against their annual limit. And the interest, when you report it, will not be taxable for California or other state tax purposes. So, but the reason I kind of threw this on there was because you can also purchase up to another additional $5,000 of what they call paper bonds using your tax refund. But that $5,000 limit is per return, not per person, as you might expect, given that the limit is per tax ID number. So there are some entities that can own these as well, but it's just not really practical to accumulate a huge amount of these by design. And the series I bonds, of course, are I is for inflation. They're inflation protected bonds. And so the interest rate will vary depending on the rate of inflation so that you're guaranteed a certain real rate of return after inflation is calculated. So at least according to the consumer price index. So anyways, I don't think that that's anything that's not going to be familiar to this crowd of investors. So the major piece of tax legislation that was introduced in 2022 was the Inflation Reduction Act, or IRA. of 2022. I really wish they would have picked a better acronym, but it is what it is, especially talking to investors. IRA means something very different usually, but for tax people in this year, it means the Inflation Reduction Act of 2022. There's a couple things that were pertinent to the IRA, to the tax system in here. One was an increase to IRS funding over the next 10 years. We're going to talk very briefly about that because there's a lot of misinformation about that floating around. They made some very large changes to the incentives to produce clean energy for your home and to increase the efficiency of your home, energy efficiency of your home. So we're going to talk about those a little bit because in both cases, they did it in a very complicated way where some of the changes took effect immediately and some of them took effect in 2023. And so there is a little bit of nuance into figuring out the best way to make sure you get the best benefit out of it, out of these new provisions. So part of the IRA was a large increase in funding, about $80 billion or $78.9 billion of funding for the Internal Revenue Service over the next 10 years, over what their normal appropriation is. The background of this is that the IRS funding has been slashed and not kept up with inflation over the last decade or so due to politics and other reasons, and that they have not been able to keep up with what the demand is for their services, especially as Congress keeps dumping new tax laws on them and then also requiring that they administer things like the Affordable Care Act, subsidies and penalties, and then when those applied actually, and then 3 rounds of stimulus payments and all of these new tax credits that were passed as part of the CARES Act in 2020, and then the American Rescue Plan Act, of 2021. So they've been having a lot of issues with making sure that they're staffed. You probably, if you had to deal with the IRS or interact with the IRS in the last 2 years, have heard that it's almost impossible to get through to them on the phone, even for practitioners. I'm not exaggerating even a little bit when I say 99 times out of 100 that I try to call them in the past 2 years, I'm told that they're too busy and I don't even get the chance to hold. It's been very frustrating to try and get a hold of them. And if you decide to write them a letter instead, it takes them about 6 to 8 months to get to process it and respond. And they almost never get it right the first time, which means you need to wait another 6 to 8 months to respond, for them to respond to your response to their response, right? So the staffing at the IRS has been grossly deficient in recent years, and they were trying to, and this bill is attempting to remedy some of that. The other thing that's been going on is serious brain drain at the IRS as their experienced employees have retired or quit. They've not been able to replace them with sufficient people to replace that knowledge that they've lost. But the bottom line is, no, there are not 87,000 new IRS agents coming to get you, despite the memes, despite the commercials, despite all the jokes and the fear mongering that's been going on. Those 87,000 agents will be hired over the next 10 years, and most of them will not be in enforcement. They will be in customer service and IT and modernizing their systems, et cetera, and answering phones. They just announced they're hiring, I think, 14,000 new people to answer the phones and process mail, so that they're trying to get rid of their backlog. The IRS is unfortunately in a position where they can't just go out and hire a bunch of temp people to attack this backlog, because it's a very technical job for the most part, and they have access to very sensitive information, and so they need to be trained properly before they can be let loose on the public. So and so they've been working and trying to, although I complained earlier about not being able to get a hold of them. I do recognize they're in a tough position. I don't necessarily blame them, but it doesn't make it less frustrating. So as a practitioner and as a taxpayer, really trying to get a hold of them to do anything. So anyways, so the outgoing commissioner, Chuck Rettig, has promised that the funding will not be used to increase the rate of audits on people with income under $400,000. They will be putting most of the increased enforcement budget towards the auditing of complex financial and tax avoidance transactions and cryptocurrency. I didn't put that last part on the slide, but that's what they said, is that they're monitoring for cryptocurrency tax compliance. They've identified that as a area of concern, and that needs attention for compliance. And then a complex partnership deals that have been structured over the past years in order to reduce taxes, sometimes legally, sometimes not, such as syndicated conservation easements and other things, which they've already been focusing on anyways, but this will just give them some more money to do it. So,
Russell,
yes.
there are two quick questions in the chat.
Oh, you cannot see the color differences in the chart. Please clarify numbers. Oh, my apologies. So this is just a breakdown on the side here that talks about, you know, where this money is going. So, oh, I see what you're saying. Yeah, they're kind of, I'm sorry, they're kind of, yeah. So enforcement is this 44% piece, and 22% is for taxpayer services, and 32% is for operations, and then 2% for modernization. That's the one that's a little more clear. I apologize for not making that color palette a little bit more distinguishable. So, and then there's a question about, can I open both an individual entity revocable trust account on Treasury Direct.com using the same tax ID? So the limit is per tax ID, and for a revocable trust, you are using your social security number as you state. So no, you would not be able to do that as two separate. You'd be subject to one limit of $10,000 per year under that SSN, not two, unfortunately. So then there's a comment that most new Treasury Direct accounts registrations go through quickly. If you are an unlucky one, it takes up to 13 weeks for acknowledgement and then additional months to process required documents. I had not heard that. So actually, when I opened some earlier this year, for myself and for my children, they were immediate. So I guess I was part of the lucky ones. So not one of the unlucky crowd. So the first thing we'll touch on for the IRA 2022 of the Inflation Reduction Act is the changes they made to energy efficient home improvement credit. This has been around for almost 2 decades, but it used to be subject to a $500 lifetime limit. So it was something that not many people had a lot of interaction with, because if they happened to be remodeling their house one year and either were aware of this credit or told their tax person about it, they probably got their $500 of credit, and then you weren't eligible for it ever again, right? So they've made some changes. Instead of a $500 lifetime limit, which still applies for 2022, the annual limit is going to be $1,200 starting next year. More expenses qualify starting next year, and the credit percentage increases starting in 2023. And that note means that the amount of credit that you're receiving was a certain percentage of your expenditure, where when it was subject to the lifetime limit of $500 through this year. And then, but starting next year, you'll get a larger percentage of that. And then instead of a lifetime limit of $500, you'll have an annual limit of $1,200. So it's a little bit complicated to try and explain in a slide. So if you have questions about that, you can either research the tax bill or reach out after the presentation. So, but the short is that there's a certain limit as to how much you can claim for each type of improvement. So like, you know, there's like, I think a $600 limit on like windows, right? So you can't get all $1,200 as one type of expense, but it's a blended rate. And that actually existed under the $500 lifetime limit program as well. And it's continued forward that although there's now an annual limit of $1,200 instead of a lifetime limit, you still are limited by subcategory of what the expense is. So there's a question about if you exceed the $500 energy improvement credit prior to 2022, does the excess amount can be claimed in 2023? No, unfortunately not. So it does not carry over. So and even in 2023 and beyond, it does not carry over if you hit the annual limit. So so this is a relatively modest credit in the big scheme of things. Anyone who's undertaken a substantial improvement to their home or project is, you know, $500 or even $1,200 is not going to go very far, but it's better than nothing. So, and these are things that are, again, improving the energy efficiency of your home, such as replacing exterior windows with energy efficient ones, replacing your water heater or furnace with a more energy efficient one, certain geothermal improvements, although I don't think anyone pretty much ever does those around here. I've never at least run into them, so I'm only conceptually aware of what they are. So there's a question, does window tinting qualify for energy improvement? I don't believe so, but I don't know that for sure. So that may be something that needs to be researched and addressed after the presentation. So, but insulation, if you're insulating like your attic to prevent heat loss or cool air loss, then that can be as well. So these type of things that are improving the energy efficiency of your home as a whole. So, and in California specifically, which I believe most of our attendees are watching from, almost everything you can buy these days in California under the building codes qualifies for these credits, because we don't really, like, California doesn't really let people install like single pane windows anymore, right? So any window that you buy is going to be energy efficient. Same thing for air conditioning and furnace units. They're going to be qualified mostly. The manufacturer will let you know if they qualify, and you're allowed to rely on their assertions as to whether it qualifies or not. So the manufacturers work with the Department of Energy to identify, or certify that they meet these criteria, and so you're allowed to rely on those. So there's no income limit on this credit, and it only applies to improvements on your primary residence. So if you have more than one home, only improvements made to your primary residence qualify for this. So separately is the residential clean energy credit, which again has existed for many years, but had been sunsetting over time. The last time it was extended, they created the credit. It started out at 30% for a number of years of the cost of installing solar or fuel cell or solar or geothermal energy generation on your home, and then it had been starting to decrease over time and was about to actually go away entirely in another couple of years. So this has been refreshed, bumped back up to 30% through 2032. So for the next 10 years, you can still get this credit for installing solar, primarily solar. Most people are using it for solar energy, but fuel cell, geothermal, and home battery storage equipment. So from 2022 through 2032. So there's no income limit, and most purchases can be for any home you live in. It's not limited to the primary residence like the last credit was that we talked about, although fuel cells are the exception that is only for your primary residence. So there's a question, is there a limit on the cost? No. For the energy credit, the clean energy credit, there is no limit on the cost. However, you do need to be careful of how much you listen to salespeople, because they're going to tell you that a lot of things are qualified for this credit that aren't. I know a couple of years ago, one of the very popular things for solar salespeople to tell people were that if you need to replace your roof in order to support solar panels, that the entire cost of your roof qualifies. That's never been the case. The IRS has actually even clarified the instructions to make it even more obvious that that's the case. There is an argument that can be made that the costs associated with the portions that are directly underneath your panels can be included. That is a bit of an aggressive stance to take, but it is supported by the instructions. So, anyway, so you can look at that, because oftentimes when people are doing solar panels, they're also redoing their roofs. It tends to happen at the same time. So the question of what happens if the credit exceeds the tax liability, this one can carry forward. So not all of these credits carry forward, like the energy efficiency ones we just talked about does not carry forward. The vehicle tax credit that we're going to talk about next does not carry forward, but the residential clean energy credit does carry forward if you have more credit than there is tax liability. So that can be moved forward and carry forward and benefit you. So one of the changes they made starting next year in 2023 is that a separate installation of a house battery, such as a Tesla Powerwall or equivalent, that's at least 3 kilowatt hours of storage, can qualify for this credit. Before this change, it generally only qualified if it was part of a solar system, a solar energy system. So now they can be independently installed, and that'll qualify for this credit. So it does have to be something that you own. If you're leasing the panels or under a power purchase agreement, then you're not going to qualify for this credit. The person or the company that owns the panels will get that credit instead of you. But I think those are becoming a little more rare as the costs come down and the financing costs, although now they're going up again, so who knows, right? But that's just something to be aware of. So, and solar, fuel cell, and geothermal equipment all qualify for this credit. So, and it's right now 30% of the cost for 2022 into 2032. I believe that 30% is retroactive for 2022. So if you had installed solar or other of this type of equipment before August 16th when they passed this law, I think that it was like 26%, I think was the credit, or 24%, I can't remember. But that is, I believe, retroactive 30% now to the beginning of this year. So, so that was a nice bonus. So not much of this bill was the retroactive. But I think that's one of them. So the next one is the electric vehicle credit. This has been an area of considerable complexity and confusion, even amongst the tax preparer community. They changed the rules effective August 16th, so that there were certain cars that would have qualified for the credit or didn't qualify, and they may not qualify now, or they may qualify now but they didn't. But so whether you get a credit for this year or not is going to depend on when you bought the car in some cases. So like actually in June, I purchased a Hyundai electric vehicle. And because I bought it in June, I get the credit. If I bought it today, I would not, because it was not assembled in the United States. I'm sorry, in North America. It doesn't have to be in the United States. It could be in Canada or Mexico. So as well. So so that was, I guess I got a little lucky there. So, but there's also some things that apply starting next year that don't this year. There was a cap on vehicles, like the total number of electric vehicles a company sold would limit how many credits, that whether their car was eligible for the credit. So I think the only ones that really ran afoul of that were Tesla and GM, where they had sold more than 200,000 electric vehicles and were no longer eligible. Their vehicles were no longer eligible for the credit, right? Starting next year, though, that quantity cap is removed, right? But they are putting into place your MSRP cap. It can't be more than, I think, $55,000 for a passenger vehicle, or $80,000 for a SUV or truck, right? And then it has to be, and so those take effect next year, right? There's also going to be income limits next year. You can't earn over a certain amount of money and qualify for these credits. And there's going to be requirements. There are currently requirements now starting on August 16th that the vehicle have its final assembly, or at least part of its final assembly, in North America, which, as I mentioned a minute ago, eliminates the Hyundai electric vehicle and some others. Starting next year, there'll also be a credit available for used EVs if you're buying an electric vehicle that's used, but there is a price cap and income limit on that as well. There's a question: what if you booked in March but are getting delivery in December? As I experienced when I was shopping for a car this year, of course, supplies are tight and the waiting lists are long. So what the IRS's position was is that if you had a binding contract with a car dealership to purchase a specific vehicle that was dated before August 16th, then you would still qualify for that credit under the old rules without regard to the domestic assembly requirement and other things. So, so you would need to take a look at your specific agreement with the car dealership. If you simply put down a security deposit, that might or might not qualify. So you would need to really kind of dig into, are you actually obligated to buy this vehicle, or are they just reserving it for you, right? So I think that's going to be the main thing. But but yes, you could still potentially qualify on a car delivered in December if the written contract for the sale was signed prior to August 16th. So income limits on the electric are I don't actually have those written down. I think it's around $150,000 for a adjusted gross income for an individual, or $300,000 for a married joint return, approximately. So, and another question: what if the MSRP is over the limit? Do you get no credit? As far as I understand it, yes. There's not a phase out; it's just a hard cap. So, I had a client ask a question a bit ago about like the X5 from BMW, and my initial thought was, well, that's more than $55,000. No, but then I looked into it and realized it's classified as an SUV and therefore is subject to the $80,000 limit. So you can look at that as well. And again, those MSRP limits don't take effect until next year. So if you have the opportunity to buy one this year that's not going to qualify next year, you might consider whether you accelerate your purchase and do it before the end of 2022, assuming you can actually take delivery, which is subject to dealer availability. Right? So there also is, I have this on the bottom, I have this note about component sourcing. There are some component sourcing rules that will phase in over time for the battery. I think they're trying to encourage manufacturers to find sources that are less controversial. A lot of the countries where these minerals are being mined don't treat their people very well and don't treat their workers very well. And I think that this is engineered to or designed to try and shift purchasing away from those countries in order so that the buyers of the cars can qualify for this credit. As far as I understand it, no car qualifies under these rules as of right now, and so those will be phasing in over time. And I'm sure they'll have to adjust them depending on how whether there are these components of it or these minerals available from other sources in sufficient quantities. So the question again is, if you have above $55,000, do you credit for the first $55,000? Again, my understanding is no. It's a hard cap. If the vehicle's MSRP is over the limit, you will not get the credit, is my understanding. So again, this just generated a considerable amount of confusion because some of these rules, like the domestic or the North America assembly requirement, took effect immediately, whereas some of the other limitations, such as income caps and MSRP caps, don't take effect until next year. And so there's going to be a lot of chaos in this filing season about this, because you got to figure out, okay, what was purchased, when, what rules were in effect at that time, et cetera. So the used EV credit is going to be, I believe, up to $4,000, but the limit, I believe, is $22,500 of sale price. And so there's going to be a fairly low end selection of cars that are going to qualify for that. It is income limited. I don't know the limits off the top of my head. I'm sorry. And they are working on a way which I think may not take effect until 2024 for the dealer to get the credit directly and to therefore reduce the amount of the purchase, the cash required for the purchase. But as of right now, that doesn't exist. So the question of MSRP and not purchase price. Yes, that is correct. It is the MSRP, not the purchase price. Anyone who shopped for a car this year knows that you're paying well over MSRP for most of them because of limited availability. But yes, it is the MSRP that is the determination, not the actual price you pay. So there's a question of, do hybrid vehicles qualify? As under the current law, plug-in hybrids do qualify. And I don't believe it's under the current law, or up till August, there was the amount of credit that qualified for depended on the capacity of the battery. I don't believe that's the case anymore. I believe that, yes, the plug-in credits, the plug-in hybrids do qualify for the full credit. So here in California, where we've decreed that you're not going to be able to buy a new purely gas powered vehicle after a certain time, more and more EVs are going to be coming online, and this is going to become more and more something that's a factor in more and more purchases, I think. So but anyway, so again, domestic assembly requirement that takes place now. The component sourcing is next year. Income limit is next year. MSRP cap is next year, and the gross vehicle caps, the removal of the cap on the number of vehicles that the manufacturer could sell and still qualify for this credit is also going away next year. So Does the state of California also give a credit? No. California has historically offered a rebate. I think I read that that is going away for some reason though, but I'm not sure. It was still in effect in June when I purchased my own car. That's all I can tell you. So, and will there be a list of qualifying vehicles? Yes, the Department of Energy has published a list of vehicles that it believes meets the criteria that outlined in the IRA of 2022. You can always do a Google search for that. So, and most of the EVs that were on the market do qualify, but there are some like mine that are built overseas and imported, and those will no longer qualify. So there does, I think I've heard some rumors that there'll be a change or a relaxing of that domestic assembly requirement, but I don't know whether that's going to happen or not. So there's a question of what's the income limit to claim credit. I believe it's around $150,000 for an individual and $300,000 for a joint return. So this is just more of what I already said, basically. So that the as of August 16, 2022, any car that doesn't meet the assembly requirement as final assembly or substantial assembly in North America does no longer qualify. Price and income limits apply from 2023 to 2032. Component sourcing requirements will phase in over time, which is all things I talked about on the last slide. So we're trucking along here. So so those are the main points that are going to impact the individuals on the Inflation Reduction Act of 2022. There were some more business related things that are not as relevant to this audience, so I didn't go into them. But you know, they created a 1% excise tax on stock purchase repurchasements by corporations. So when companies rebuy their stock, they're going to now be subject to 1% excise tax as a revenue raiser. I don't think it's going to discourage any companies from doing this, but it will be an additional cost that they have to absorb. They did implement a corporate alternative minimum tax that's tied to the amount of state earnings they've stated in their public releases for publicly traded companies. So they're going to have to pay a minimum amount of the profit they reported on their financial statements, regardless of whatever income they report on for tax purposes, right? So there's been a lot of attention paid in recent years to companies that use complex sourcing rules and engineering and tax credits to make a lot of money but pay no tax. And so this is, I think, an effort to address that to a certain extent. So although it only applies to very large companies, I think with $1 billion of profit or more, so most of us are never going to run into that. So. Oh, okay, so there's a couple more questions about it. It says, what is the income limit for energy home improvements? There isn't one. The next question, or really a shared fact, is three-wheeled vehicles are not covered under the new rules. My understanding is that's correct. I don't remember last time I saw a three-wheeled EV, but I'm sure they exist, and if they do not qualify for the $7,500 credit. So anyways, I wanted to move on and talk about some just general year-end stuff and things that to be aware of. One of the big ones, just based on the amount of questions I get about it every year, are withholding and estimated payment requirements. You know, in my practice in San Jose, we have a lot of tech employees. Tech employees tend to owe a lot of tax at the end of every year, and they don't necessarily understand why. And then after they've paid that, they usually will get a penalty, or often will get a penalty, and they don't understand that either. And so we spend a lot of time talking with our clients and prospects about how this system works and why, right? First of all, I'm going to just say it's not a very good system. It really isn't. So at least the withholding calculation system is garbage. It's not, it doesn't do a very good job. The IRS had a great opportunity to fix that when the Tax Cuts and Jobs Act was passed starting in 2018, and they had to redo all the withholding tables. They did not. They chose not to. They doubled down on the existing system. They made some changes that make it potentially better, but require that you share a lot more information with your employer than most people are comfortable with, or even realize that they have to share in order to get an accurate result for withholding. So, but anyways, We are a pay-as-you-go system. That's how the law is written. You're supposed to pay tax as you earn money. For people that are working, that takes place when they withhold tax from your paycheck, right? For people that have income that's not through their job, that income usually does not have tax withheld on it, right? And so you are supposed to pay as you go, and you may be penalized if you don't, right? And that's really the long and short of it. So because of the complexity of our tax code and system, usually you don't know how much tax you're going to owe for the year until you file your tax return, right? Even I don't, right? Like even when I do my own year-end estimates, it's just an estimate, right? With as many tools and as much knowledge as I have, it's still a guess, right? And we can get pretty close sometimes, but it's never perfect. So there are safe harbor provisions that are created in order to avoid those estimated penalties, underpayment penalties, which we'll explain shortly. And then you're supposed to make estimated tax payments when your withholding isn't enough to meet that safe harbor requirement. So, so the top of the next half of the slide is that the requirement is to pay at least the lesser of 90% of the current year total tax or 110% of the prior year's total tax. If you make less than $150,000, then the requirement is actually 100% of the prior year tax, not 110. But most people in this valley have income, at least that's just because they need to in order to afford to live here. So we just kind of give the 110 as a basic, right? California uses the same rules with the caveat that if your taxable income is over $1 million, they do not allow you to use the 110% of the prior year safe harbor, and you must use the 90% of the current year safe harbor. So underpayment penalties apply to the difference between your total payments and the safe harbor amount, and are calculated by the month, right? And the timing of income can be considered, but the default assumption, if you don't tell them otherwise, is that income is earned equally throughout the year. So there's a question here about, do you have to pay as you go on capital gains like the sale of a house? Yes, but with the subject of the safe harbor rules, right? Oftentimes, if you have capital gains from the sale of a house, that means your income is very high this year compared to what it normally is, and therefore the 110% of the prior year safe harbor may not be as high as what you actually owe, right? And once you hit that safe harbor, whichever one applies to you, any tax that's due above that, as long as it's paid by the due date of the return, is not subject to underpayment penalty, right? So if you had all of a sudden $100,000 of tax due on the sale of your home because you had a large capital gain, you may not need to make an estimated payment to avoid underpayment penalties on that. So another question is, if by December withholding exceeds tax, can fourth estimated payment be skipped without penalty? Yes. And also withholding has the special treatment that it's assumed to have been made equally throughout the year. So even if you suddenly increase your withholding in December and get over their safe harbor threshold, just from withholding, it's going to be treated as if you met your safe harbor for each quarter. So, but yes, the estimated payments function is to bridge the difference or the gap between what your withholding is from other sources and what your safe harbor is. So if your withholding meets your safe harbor, then you do not need to make an estimated payment. So you can, but you're not required to. So the IRS will never complain about you paying your tax early. I probably shouldn't say never, but as far as I can imagine, never, right? But so they're only concerned about you paying it late. So, and then please clarify the benefit of paying all estimated taxes from an IRA as an RMD. I mean, that's really just a cash flow issue for you, right? If it makes so there's two potential answers to this question, right? The question is making an estimated tax payment from an IRA as an RMD, right? Which would be all of your estimated payments, right? But most IRAs will also allow you to withhold taxes, in which case it would be withholding, not an estimated payment. And the benefit of that, as I mentioned a minute ago, would be that the withholding will be treated as being made equally throughout the year. So, so if you had a large amount of income, like let's say you sold your house for a large gain in March, right? And then you didn't make an estimated payment, but you were required to, then potentially the underpayment penalty on that tax could apply for the other 3 quarters, right? Even if you pay the tax by April of the following year, right? And so, but if you took an RMD in December and said, okay, withhold enough to cover my safe harbor, then even though you did that in December, then it would still, you would still meet your requirement for the prior quarters as well, because withholding again is treated as being made evenly throughout the year, regardless of when it's actually done. So, and there's a question about what is meant by safe harbor. A safe harbor provision is it's a threshold where if you meet that threshold, you won't be subject to underpayment penalties no matter what, right? So you could owe $1 million in tax for 2022, but as long as you meet your safe harbor amount, then you won't be charged underpayment penalties on it, right? And if you don't meet your safe harbor threshold, then you're only charged underpayment penalties on the difference between what you did pay and what that safe harbor threshold is. So you know, we don't know what our tax is going to be for this year until we file the return, as I said, but we do know how much tax we paid last year if we filed a return, right? So 110% is a number that's fixed, and we know what that is, and that's something that you can easily target, right? 90% of this year, a bit fuzzier, right? It's a bit more guesswork, and there's some room for error there. But you know, but those are the two thresholds to keep in mind, and whichever one is smaller in the year will be the one that applies. So. So Deborah is telling us that withholding from retirement account distributions can be used to help minimize under withholding penalty, as we just discussed, yes. Providing the administrator allows it, the entire distribution, including the withholding, can then be rolled back into the account. Not sure about that. It depends on if, I guess, yeah, you could do it as an indirect IRA rollover. That could be a way to take money that you would otherwise just pay as an estimated payment and turn it into withholding to minimize underpayment penalties. That is a valid strategy, yes. She said that state and federal safe harbors are different. In California, that's not the case, except for the caveat, as I mentioned before, that if the taxable income is over $1 million, then there is a small difference in which one applies. So there's a question of, if we have a real estate investment sale leading to capital gains in the year end, how should one deal with it to avoid penalties? So the bottom right corner of this slide mentions that timing of income can be considered, but the default assumption is that income is earned equally throughout the year. So for both IRS and California, they have a form. IRS is called 2210, California is 5805, right? That calculates this underpayment penalty. And there's a short version that's just assumes all of your income is taxed, or I'm sorry, earned throughout the year equally. And there's a long version where you can tell them, no, I earned this much money in this quarter, and this much money in this quarter, and this much money in this quarter, right? And so if you have a large capital gain in the fourth quarter, it would most likely benefit you to do that longer version of the form to tell them, no, this income wasn't actually earned until the fourth quarter, so they don't try and assess penalty on it for the rest of the year, right? So there is that is a way. It's optional. If you don't calculate the penalty, the IRS in California will calculate it for you, assuming the short form would apply. So meeting last year, safe harbor, you can avoid the capital gains on a property until April tax. Ultimately, I believe what you're saying is you won't be penalized for not paying the tax on that capital gain once you until April, as long as you meet your safe harbor. In which case, yes, that is correct. So. And at what point will the rental expenses cannot be deducted? That will be addressed later, actually. So I'm gonna table that one until later. So reasons your withholding might not be enough to avoid this penalty is partly the way the IRS calculates withholding is not accurate, as I mentioned before, right? The payroll withholding calculation is limited to, in general, looking at how much your current paycheck is, multiplying that by the number of paycheck times per year you're being paid, and assessing the tax on that amount, right? So if you have multiple earners, multiple jobs, lots of income that are not subject to withholding, you have other deductions that are not factored in, then the amount of withholding is not going to be accurate, right? And that's always been the case since the current scheme has been put into place, right? If you are single with one job, it does a pretty good job, right? If you don't have any kids and don't itemize deductions, right? If it gets much beyond that, it's a bit of a crapshoot, unfortunately. So even when I'm working on withholding, I back into it. I try to figure out how much withholding we need, and then figure out what settings we need to get there, because that's really the only way to do it. And I'm fortunate that I have the tools to do that, and most people do not. So it can be a source of frustration because you can do everything right and still end up with the wrong amount of withholding and still end up with a penalty, right? So so in this valley, in Silicon Valley, where we have a lot of tech workers, and the employees tend to have a large part of their compensation as a bonus or as stock benefits through restricted stock units or RSUs, and employee stock purchase plans or ESPPs, right? And so the IRS has a mandate to employers that they must withhold 22% income tax on any such compensation, without regard to what your paycheck withholdings would normally dictate, and without regard to whatever your actual tax bracket is, right? This applies for people with compensation up to $1 million, at which time that becomes a 37% withholding rate. The problem with that is that the 37% tax bracket starts at around $400,000. And so in this valley, we have a lot of people that have, half or more of their W-2, which looks impressive, on paper, is going to be from these transactions and be under withheld by as much as 15%, even if they set all of their withholding perfectly, right? And so it's a source of frustration for me and many of my clients that, again, you can set everything correct and then have this happen, have this under withholding, and they don't realize it, and then they owe this amount of money, right? California has a similar mandate, but it's 12.3% of the for the withholding rate, which is actually higher than most people pay tax to California at. So for California purposes, it's common to not owe or to have or to owe a much smaller amount compared to the IRS when they file in this valley. So but I spend a lot of time every year explaining this to a lot of people, so I wanted to just kind of go over it because it's not something that's widely understood, but it is something that impacts people very widely. So some employers are now allowing employees to opt into a higher rate of withholding. However, the only one I'm aware of specifically is Apple. I've heard that others are, but I don't know which ones they are. So, but I know Apple has been giving their employees for the last year at least the option to withhold a different, higher than 22% on those if they wish. So that can mitigate some of this. So the trade-off though is that you're getting, so when you get restricted stock units, for those that aren't familiar, you're taxed on the value of those shares when they vest, right? So if you get 100 shares, then whatever the market price of that stock is that year or that day, 100 times that is added to your W-2, and they have to withhold tax on that. So they withhold a certain number of shares to cover that cash requirement, right? So if you're having more tax withheld, they're holding more shares back, and therefore, if you have if the stock is appreciating, you have less room for growth, right? The reason you'll have fewer shares issued to you. So for employees, it's it's a trade-off where you'd say, okay, well, you might avoid an underpayment penalty, but lose out on appreciation. In 2021, that would have been a really good bet, right? To like not have those stocks sold. In 2022, it probably wasn't less of a good bet because stocks have been down so much, right? And so it's an investment decision and investment risk just like any others. So there's a question: for any example, if in 2021 you owed $100 in taxes, in 2022 this year you pay 110% to be in the safe harbor, but by 4/18/23 when you file you owe $700,000 in taxes, there'd be no penalty if you paid the 110. Yes, that is correct. No matter what you owe above the safe harbor, there's no underpayment penalty and no late payment penalty as long as you pay by the due date of the return. So that is 100% correct. So what about the withholding on Social Security income is asked? That is treated like any other withholding. You can opt to have, I think, 20% or 10% flat withheld from your Social Security, and that is treated like any other withholding. In other words, it's treated as if it's paid equally throughout the year. So, can we pay the taxes if RSU vest in cash as opposed to stock withholdings? Yes, but that's something to arrange with your employer because you're going to have to write them a big check. So for those, so yes, there's nothing saying they can't do that, but for most employees who don't have enough cash or don't prefer to tie up their cash that way, and just so the default is always going to be that they withhold shares. If you discuss that with your benefits department, I'm sure you can arrange otherwise. So. And then the estimated tax payment due dates. The top part is the dates that the income is being, if you're doing timing based, right? And so they're called quarters, but they're not really, as you can see. Like the first quarter is, but the second quarter is only 2 months, and the third quarter is only 3 months, right? And then the fourth quarter is 4 months. That's just the way that the system is made, unfortunately, right? So April 15th, June 15th, September 15th, and then January 15th of the following year are the 4 due dates. Or if those fall on a holiday or weekend, then the next business day. So, so like this year, we'd say, okay, we've already discussed that for the first quarter, or the due date of the tax return is going to be April 18th. That would also be the due date of the first quarter payment for 2023. So. There's a question, will I be covering RMD changes for 2022? No, I don't believe so. There was the Secure Act passed in like 2000 that had changed when the RMD dates start, but other than that, there haven't been any changes for 2022 that I'm aware of. So if I'm not aware of something that I should be, please let me know in the chat. So there's a question, if I make a Roth conversion of $20,000 in 2022, is that conversion subject to an estimated payment made in 2022? Yes, but with the safe harbors in mind, right? So, or if you're withholding from other sources, or estimated payments are sufficient to cover your safe harbor, you may not need to specifically make an estimated payment on your Roth conversion. So everything is, unfortunately, the diaper answer. It depends, because everything depends. So. Another thing I've got a lot of questions about, especially last year with GameStop and AMC and all the other insanity that happened in early years, and then is about watch sale rules. People are very concerned about them, often when I don't believe they need to be. So I wanted to kind of go over how those rules work. A watch sale occurs when you sell an investment at a loss and then repurchase the same investment within 30 days. So this often happens with people that are day traders, or that frequently buy and sell stock over a short period of time. For a watch sale, what happens is that the capital loss from the sale is temporarily suspended and added to the basis of the replacement, right? So if you bought something for $100 and sold it for 50, and then bought it sooner than 30 days for 60, then your $50 loss would be added to the $60 purchase price, and your basis in the new share would be $110 instead of $60, right? And so you don't lose the sale, the loss from the sale, but it gets deferred until you sell the replacement security. From a practical standpoint, the brokerages all seem to track this for you these days, and they'll automatically adjust. And to avoid being hit by this rule, all you need to do is make sure you sell that other investment before the end of the year. And if you don't, then that loss is going to be deferred until you do. So, but it oftentimes looks a lot scarier than it really is, just because of the way that it's presented, right? So there's a comment that they're concerned about watch sale between taxable and non-taxable accounts, as well as stock versus options on the stock and different options on the same stock. That is something that is beyond the scope of this, but it is an area of concern. And when I said that the brokerages are going to track that, I really should have clarified and said the brokerages are going to track watch sales in a certain account, right? They're not going to generally have the ability to recognize that, oh yes, we sold this stock in our taxable brokerage account, but then repurchased it in our IRA, right? And that does complicate things, so, but that's beyond the scope of what we're talking about today. So it is something to be aware of if you're a very sophisticated and high volume trader, but that's not something we're going to cover today. So the other comment is that you lose the loss if the purchase is made in an IRA. I believe that's accurate, because the watch sale, defers the loss until you sell the replacement, but anything that happens inside the IRA never shows up on your tax return. So I do believe that is correct. Another thing people ask about a lot in my practice are loss harvesting. If you have large capital gains in a year, you can mitigate that by harvesting loss positions before the end of the year, if it makes sense to do something from an investment standpoint. I'm a big fan of what I call not letting the tax tail wag the dog. You never make investment decisions, or very rarely does it make sense to make investment decisions solely based on taxes, right? So if it's a loss position that you would want to exit anyways, then it might make sense to exit it before the end of the year. So capital losses are netted in 3 different phases: short-term losses versus short-term gains, long-term losses versus long-term gains, and then the 2 amounts are netted out as a whole, right? So a short-term loss will reduce short-term gain first, right? And so if you're loss harvesting and you have short-term gain, you usually would want to target those first, if you're not going to completely neutralize your entire gain for the year. So, so that's what it says: prioritize minimizing short-term losses to have. I'm sorry, it should say prioritize minimizing short-term gain to have the biggest impact is what it should say. I apologize. And then your overall your capital losses that you conduct in a year are as much as your gains are plus $3,000, and any excess above that is going to carry over to the following year, and will continue to do so until it's used up or until you die. So when you die, the capital loss carry forward goes away. So again, if you look at your portfolio and your taxable portfolios and say, I have a very large amount of capital gains, then you can sometimes minimize this with by harvesting losses. One thing to keep in mind, which I probably don't actually need to remind you of, but I'm saying it just in case anyways, most of the mutual funds make large capital gain distributions in like around mid-December. So even if it doesn't look like you have a large gain right now, check again in mid-December and make sure, right? There were a couple of Vanguard funds that made huge distributions at the end of last year that caught a lot of people by surprise, mostly because they weren't paying attention to their emails. But there were very, very large distributions from some of the Vanguard funds last year, and that would completely change the amount of tax that's due for the year, right? So, and others, that's probably not going to happen again to that extent. But around the middle of December is usually when the mutual funds will make the distributions of capital gains for the year. So there's a question: how to deduct stock education or stock subscription expenses. Generally, you can't unless you're a professional trader, which is a very high standard to meet. And there are some downsides to that election as well, right? So there used to be a classification of itemized deductions called the miscellaneous 2% itemized deduction, where there was a bucket of different deductions, including investment expenses, investment management fees, stock subscriptions, like what they're asking about right now, attorney fees for generating taxable income, safety deposit box, unreimbursed employee expenses. They all kind of went into there, and tax prep fees too, right? But that whole classification of deductions has been suspended from 2018 to 2026 by the Tax Cuts and Jobs Act. So that's no longer available. California did not make that change, but you have to be itemizing, and your overall total has to be over 2% before any of it can be deducted. So if you invested in a startup, non-public, and that company folded, how and where do you report the investment loss? It depends on the size of the company when you invested it. You would want to look at whether it qualifies for IRC 1244 small business stock treatment, which would make it a ordinary loss rather than a capital loss up to $50,000 per individual. So otherwise, it's a capital loss. So do you have any idea about what to do with Russian telecom ADR stock that are not tradable in the United States now, sitting in account and can't buy anymore, sell the ones I have? I actually do not have any insight to contribute to that specific scenario. Unfortunately, I apologize. So, and then how to declare professional and what are the downsides? Professional trader. Well, one of the main downsides is going to be a very high audit risk, is because a lot of people claim this when they don't actually meet the criteria, right? Where this is your full-time job that you're doing, more than half of your time is spent doing stock trading, and more than half of your income is generated using this type of thing. but because stock gain is also reported on Schedule D, but your expenses are going to be reported on Schedule C, you're going to have a Schedule C with no income and a bunch of expenses, which draws the IRS attention, right? That doesn't mean don't do it. It just means that know what you're doing and what the trade-offs are, right? Oftentimes, another thing that people ask about when they are very high frequency trading is mark-to-market election, which is when you are treated as selling all positions at the end of the year and recognizing a gain or loss based on the price at that date. If you make that election 1 year because it benefits you, it may not in the future year, and it's very difficult or impossible to change back. So, but that's also something that's generally only available to professional traders. So, can you declare professional at the end of the year? It's something that a determination you would make when you file your taxes. So, yes, basically. So, but it's similar to professional gamblers, right? At least for tax treatment. Whether it's similar to professional gamblers in other ways is for a topic for another discussion, right? But the same thing applies though, is that you have you're able to deduct certain expenses that are part of the job of doing that, but then the experience is a high audit rate. So, and I want to repeat again, and fear of audit is not a reason, in my opinion, to not do something that's legitimate and allowed. But even a zero change audit is a pretty miserable experience, and so you have to really be aware of what the triggers are. And there's no guarantees either way. There's almost nothing that's going to guarantee that you get audited, and there's almost nothing that's going to guarantee that you don't. Right? We do know that what tends to make people more likely to be audited or less likely to be audited based on what we see in the industry of what's actually being audited, right? But there's no guarantees either way. So, a brief note on cryptocurrency and NFTs, because they've been a very hot topic in the last couple of years. The market seems to be well and truly imploded, but it still is relevant for a lot of investors. They're generally traded just like stocks, right? So if you buy a coin and you sell a coin, you have a capital gain or loss, right? As of right now, I believe that wash sales do not apply to crypto. I don't believe they've addressed that as of right now. But if they did, I haven't heard of it. So, so that is one difference of that. There's also people that will stake coins, where they will put up a certain number of coins to be held for verification purposes or liquidity purposes for another investor or another company, and they'll be awarded coins as a reward for doing so. And as of right now, there's no definitive answer as to whether those coins are income. I believe they will be, but they have not. This has not been tested yet. So, but in a certain extent, it's not different from a CD, right? And technically, I understand. Yes, there are some differences between that, but you're locking up your assets for a certain period of time in exchange for assets that are going to be awarded to you for that. To me, that's interest. I believe it will be taxed as income, but as of right now, there has not been there hasn't been guidance on it from the IRS, and there's not been a tax court case to decide on that. So, if you're mining coins or generating NFTs, typically the value or the sale price is going to result in business income rather than capital gain, because you're in the business of mining coins or the business of generating NFTs, right? If you're purchasing if you sell those later, then there might be a gain or loss, capital gain or loss on the change in value between the creation and the sale. So, this is an area of concern for the IRS, and they're expected to devote significant resources toward making sure the taxpayers are properly reporting income from the sale of digital assets like cryptocurrencies and NFTs. That is one of the areas of enforcement they're going to be focusing on with their increased enforcement budget that we talked about several slides back. So, just to be aware, it's not necessarily as anonymous as the promises. So, question what an NFT is. I apologize for not clarifying that. NFT stands for non-fungible token. It is a digital asset, typically a creation, an art creation or something that's unique, that someone purchases the exclusive rights to. So that is a market of, there's been any number of forms that that's taken from, songs to pieces of art to clips of video from games, of sporting events and stuff like that. So there was a lot of grifting going on, to be frank, but there's also a lot of legitimate ways to invest in this as well. So, and non-fungible means that it's unique. It's not something that can be substituted or duplicated. So for pre-tax contributions, your IRAs and HSA accounts for 2022 can be contributions can be made up until the due date of the return, 4/17. I said 4/18 earlier. I think 4/17 is the correct number, or the correct date, unless you're over in some of the East Coast states that have a Patriots Day on that day. I apologize for that inconsistency. So, contributions for SEP IRA, solo 401ks, and defined benefit plans can be made up until the due date of your business tax return, including extensions. If you're a sole proprietor, Schedule C filer, that does mean you'd have until October 15th. If you are an S corporation or a partnership, that means you have until September 15th potentially to make your funding contributions for 2022 and still deduct it on your 2022 return. So these are among the very few ways that you can reduce your tax bill for 2022 after December 31st. So sometimes people like to do these things. So. Required minimum distributions, if you're subject to them, I'm sure you're familiar with them. Most institutions will automatically calculate these and send them to you if you haven't taken out enough to meet your requirement before the end of the year, because if you don't, there's an excise tax of 50% of the RMD you didn't take can be due. In practice, I don't know that I've ever seen that actually assessed. Usually if you miss one, you just take it out as soon as you discover it and you ask the IRS to waive the penalty, and I've never had them kick it back. So there is some leeway. I mean, but if you think about what a required minimum distribution function is, they want to tax the income, right? Because once the money's in the IRA, they can't tax it until it comes out for the 401k, right? So, and so this is a mechanism to compel you to withdraw money so that they can tax it. So as long as you're paying the tax on it, they're generally fine, right? And even though it should have been, some of that tax may have been paid, should have been paid in the prior year, perhaps, right? So, so that's just the long short of it. They did make some changes to the RMD age. It used to be 70 and a half. I believe it's now 72 and a half. After the Secure Act was passed a couple of years ago, and the new age only took effect for people that weren't already taking RMDs because they were over 70 and a half when the law was passed. So. There's a question about the last slide. Says, curious as to what happens for income taxes to those that had accounts with FTX, which has filed for bankruptcy. They may not receive final tax statements. That, as far as I'm concerned, to be treated just like any other capital loss. It would just be a worthless security, and you would not be able to. You would just take a capital loss on your basis. So, there's a question about QCDs, which I was about to talk about. So I'm going to table that for a second. Qualified charitable distributions, or QCDs, can be made, which are a direct transfer from an IRA, not a 401k, to a 501c3 organization. You can take up to $100,000 per year and not have it treated as income on your tax return, but it does count towards your RMD requirement, right? So a QCD is not treated as taxable income, and the donation is not deductible. However, they are still reported on 1099-R as a normal distribution. And so you either need to tell your software that it was a QCD, or make sure your preparer knows what was a QCD so that it can be excluded from income. So that is an area of confusion that often happens. Like, if the client doesn't tell me that it was a QCD, I don't know about it, right? So, and sometimes I don't know about it until they say, hey, why is this full distribution on my return as taxable income when I give it to a charity, right? So unfortunately, the reporting, even though the check is generated by the custodian and sent directly to the charity, it does not get reported any different on your 1099. So you have to separately tell your preparer, tell your software about that. So Roth IRAs do not have a RMD during the owner's lifetime, but beneficiaries do have an RMD from them. So because again, the IRS wants to tax the contents of an IRA. So a Roth IRA, when it's distributed after you're 59 and a half, and it's been at least 5 years since your initial contribution, are not taxable. So there's no motivation for the IRS to compel a distribution. However, they do have a motivation for the beneficiary to make sure that they don't let that money grow tax-free for 50 years and then have a huge amount of money, Peter Thiel style, right? And not have any taxable income when it gets distributed. So Roth IRAs for beneficiaries are subject to the same 10-year withdrawal requirement, I believe, as traditional IRAs for beneficiaries, and so they have to liquidate the account within 10 years after they inherit it. So there's so QCD is still 70.5. I believe it's 72 now because it's tied to a QCD only applies when you're subject to required minimum distributions, right? I don't believe it's an option before then. So you can't do a QCD out of an IRA before your RMD age. So what level of pain does a QCD make sense? Is it donating 100 or 500 or whatever? The time it makes the most sense is if you have other deductions, such as medical expenses, that are limited based on your adjusted gross income, where having that income not be as part of your, having that distribution not be part of your AGI can be beneficial, right? Or we talked about earlier that there's some income limits on your cars, your EV credits and that kind of stuff, right? Sometimes those things apply. You can worry about IRMA if you're subject to, if you're enrolled in Medicare. IRMA is a system that charges people who make more higher Medicare premiums. So that can be something that can make a difference as well. Or if you don't itemize deductions and therefore wouldn't get a deduction for the donation anyways, right? The standard deduction for a married couple that's over the age of 60 is about $28,000, right? If you are limited to $10,000 in your property tax and state payments and your mortgage is paid off, you may not even be itemizing, right? And therefore this is a way to avoid tax on those donations without the need to itemize deductions. So there's a question here. I'm 63, inherited non-spousal traditional and Roth. There's a 10-year rule. I'm considered eligible designated beneficiary. My understanding is I don't have to adhere to the 10-year distribution rule. Can you talk a little bit about inherited IRA distributions and how it's taxed? That's not actually an area I'm super strong in, unfortunately. I believe that I'm not familiar with that rule, unfortunately. I'm not able to share an opinion or comment on that. So I'm not involved in that aspect of it. I'm usually just reporting what's been distributed. So I'm sorry. So most IRA administrators have minimum QCD payment requirements. That makes sense because there is an administrative cost to issuing those checks. So you'd want to check with your specific account custodian and see what those requirements are. Are checks drawing on an RMD paid to a 501c3 valid where I'm the one writing the check? It's not considered a QCD, meaning that it would be deductible as a charitable contribution, just same as any others, but it would not be treated, would not be excluded from your adjusted gross income the way that a QCD would be. So the checks for a QCD have to come directly from the custodian and go directly to the 501c3 is my understanding. So, and then there's a note that says the Secure Act didn't change the age for QCD. Oh, I didn't realize that. You may be right. I apologize. So has it been changed since then? I don't know because I didn't know that it hadn't been changed to begin with. So apparently that's something I missed. I apologize for that. So we have a couple notes about charitable donation strategies to try and get the maximum benefit out of those. We mentioned in the last slide, hey, standard deduction if you're retired and over 60 is like $28,000, right? So you may not even be itemizing, right? So if you make a donation, it has no impact on your taxes. California's standard deduction is like $7,000. So for a married couple, I think, or 8,000. So you might be itemizing for California, even if you aren't for the federal, but that's going to get you about a 10% tax benefit at most, right? Compared to 22 or 25 or 37% or whatever on the federal side. So, so you can consider bunching up the multiple years donations if you have the cash to do so, where instead of donating $10,000 each year, you donate $20,000 in 1 year and nothing in the next year. Charities don't really like that. They want you to give them $20,000 every year if you do that. But as long as you communicate to them what you're doing, hopefully they won't give you too much of a hard time. but you can do that, and sometimes that can make it so that you itemize in a year where you would otherwise get a tax benefit for it, right? If you're making a donation that's significant, several $1,000s or more, you can often donate an appreciated stock or other property to the charity. Most charities that are of any decent size can accept those. The benefit of doing that is that you won't have to sell the stock and pay the tax on the gain, but you still get a full deduction for the fair market value of the shares. So a lot of my clients that have shares in startups or have old RSUs and ESPPs vesting, from Apple when it was $100, 3 splits ago, right? They're donating these shares and using that to avoid having to pay tax on all the appreciation that's been going on, right? And then a donor advised fund is a charitable fund that most brokerages seem to have. I know Schwab has one, Vanguard has one, Fidelity has one. I think all of them do, really. And it's a charitable fund where you can donate money or stock to, and then the fund will distribute the amounts to charity over time the way you designate and way you instruct them to. So it's a way that if you have a very high income event year, such as selling your house, or your company got bought, or you got a huge bonus, or you did really well on crypto and GameStop, right? You can kind of sink all the benefit into 1 year without having to give all the money away in 1 year, right? And also, if you're dealing with a smaller charity, like maybe your church or something like that, I'm not sure if churches are valid for a donor advised fund, but let's say that you're working with a smaller charity that doesn't have the ability to accept a stock donation. You can donate the stock to the donor advised fund, and then have them send the money to your charity and still get that same avoidance of the capital gain while giving the money to the charity that you wanted to. So there's a couple of questions. Sorry. They say, do QCDs reduce your AGI? And if you were taking charitable non-QCD deduction, would that reduce your AGI? So AGI stands for adjusted gross income. So, and we kind of think about that as above the line deduction, below the line deduction, right? So any deduction that changes your AGI is considered above the line, right? And a QCD would do that because you'd be reducing the amount of income that's being reported from the distribution, right? A charitable deduction or other itemized deduction is below the line, so it reduces your taxable income, but does not reduce your adjusted gross income, right? And so the difference is a little bit probably finicky to most people, but and it doesn't matter for most things in the end, but there are a couple things that are queued on your adjusted gross income, such as your ability to deduct an IRA contribution, deductions for medical expenses that are limited to only those that are over 7.5% of your AGI, whether you qualify for certain credits like the vehicle credits we were talking about starting next year where there's income limitations. So for the amount of income tax you pay, it doesn't generally make a difference, but there are some instances where having a lower AGI would be beneficial compared to just having a lower taxable income. Sorry. And again, and where QCDs can be useful in times where you don't itemize deductions and therefore wouldn't normally get a tax benefit for making those donations if you just made them out of your taxable or after-tax funds. So there's a comment that says, I tell Vanguard to write a check for my IRA to a charity. The check comes to me and I mail it to the charity. I didn't know that. So, but the check would still come from Vanguard, not from you, and therefore it should qualify as a QCD. So, CompuServe sold my company stock due to low amount. I have not cashed the check. Can I still ask them to transfer it to my IRA? Only if it was in an IRA. I mean, you can't take a company stock that was sold outside of an IRA and roll it into an IRA unless it's part of a normal contribution. I'm a little confused by that question. So if I didn't answer your question, please let me know. So donor advised funds can be helpful to bunch donations by tax year and donate to the charities over time. That's correct. That's what I said. And I agree with that. How would the value of a donated stocks be calculated? Your basis or price on day of donation, which could vary a lot. Most of the times you would use what they call a high-low average price, where you take the high and the low price, which is why they call it that, for the day and average them together and use that as your basis of your valuation. So for a donated stock. So Question about gifts to children. If husband and wife both have both names on each other's checking accounts, but each has just one single SSN on each owner account, although both names appear, can they both give $16,000 to each child yearly? Well, regardless of all the other stuff, yes. You know, you can, married spouses can do elect what they call gift splitting, where regardless of the where the funds are coming from or who gives what to whom, you can elect that your spouse, that each gift is treated as given half by each spouse. So for married couples, that can be a powerful strategy. Even in states where, you know, where it's not community property like California, where the difference is kind of moot. So does donating appreciated stock require itemizing to get deduction? Yes, it does. So, and then can one invest in both IRA? I'm sorry, the caveat to that. No, never mind. Sorry. Yes, if you're donating stock, you need to itemize to get deductions. If you're donating cash, there was a provision in 2020 and 2021 to deduct a certain amount of donations, even if you weren't itemizing, but those were limited to cash donations. So can one invest in both IRA and 401k? Yes, but the IRA contribution will probably not be deductible, right? And so we have not really gotten into IRA basis in this presentation. We do have some time, so I'll just briefly go into it. Most of the time when you put money into a 401k or IRA, it's on a pre-tax basis, meaning that you exclude that contribution from your taxable income for the year. IRAs are restricted because they are meant to be, they're intended primarily to be for people that don't have an option to save for retirement through their employer, right? And so if you have access to, or you're covered by an employer-sponsored retirement plan, then the ability to deduct your IRA contribution is sharply limited. You can still make a non-deductible contribution to your IRA, which would allow you to accumulate funds in your IRA and have them grow tax deferred. And then when you take the money out, then you could avoid paying tax on the amount of your basis, which is, sorry, when you put a non-deductible amount in, it's raised basis. When you take money out, you're able to recapture a part of that basis. But it's not so straightforward as you put $6,000 in and then you take $6,000 out and that's all non-taxable. But you recapture the basis of an IRA as you draw down the whole amount. So it gets fairly complicated to try and explain. But let's say you have $5,000 you're putting into, and you had $95,000, and you put so you have $100,000, right? You had $95,000 and you added 5 non-deductible. You have $100,000, you take out 5, you've taken out 5% of your IRA, and therefore you get to recapture 5% of your $5,000 basis, right? And so a lot of times this comes up in the context of people doing backdoor Roth IRA contributions, which are when you do this specifically, you put non-deductible money into an IRA and then convert it to a Roth, because you are not allowed to make a direct contribution to a Roth IRA once your income goes above around 150, right, or 170, somewhere in there, for a married couple. And so a lot of times people that have incomes higher than that will do this as a way to get money into a Roth IRA. And then, but if you have IRA balances from like other 401ks that you've rolled over, or other times you've saved before you had a 401k, then it's not a tax-free conversion, unfortunately, right? And so, and increasingly, there are also some tech employees, a lot of tech employees that are taking advantage of what is termed the mega backdoor Roth through their employer, which is making after-tax contributions out of their paychecks into their company's 401k plan and then converting that to a Roth 401k. But that's getting a little bit far afield from what we're talking about. So, question is, backdoor IRA still allowed in 2023? Yes, there was some talk a couple of years ago about doing away with it, but that never came to fruition. I think it might have been part of the Build Back Better Act at the end that they were discussing at the end of 2021, but that didn't end up making it into the IRA, which was the successor of the BBB. So there's a question: what is the strategy to reduce taxes for a large windfall from exit from Twitter. Other than donor advised funds, should one consider opportunity zone investments or MLPs? I was thinking I would consider talking about opportunity zones, but they become less relevant as we get closer to 2026. So I didn't include that in today. An opportunity zone was a tax provision created by the Tax Cuts and Jobs Act of 2018. It allows investors to defer federal tax on capital gain that's reinvested in an opportunity zone, which is an area that's been designated by each state as needing additional incentives to draw capital to improve it, right? The benefit of doing so is that the federal tax can be deferred on the amount that you reinvest up to 2026. So if you did this in 2019, that's a pretty long deferral. If you do it now, it's a shorter deferral. So fewer people are doing them now than there were. So and the other benefit that did exist is that if you left it, if it was invested for a certain amount of time before 2026, you could get a discount on the amount of federal tax that had to be repaid in that year. But those discounts no longer apply. So that's another reason why they've not been as popular. However, one of the things that still does exist for them that's very powerful potentially is that if you hold your investment in an opportunity zone for at least 10 years, then when you sell it, there's no tax for federal purposes. And I keep saying federal. California has nothing to do with this, right? They will not allow you to defer tax to 2026, and they will tax the gain on the sale of the investment even after 10 years. So, the theory was that, you know, by creating this incentive, that there would be a gold rush into properties in these zones, and to a certain extent there have been, that there would be large developments that would raise the price of everything in that zone, and that when you sell in 10 years, it should be worth a lot more than it was when you bought it, right? And so you could potentially have a very large tax-free capital gain after 10 years with an opportunity zone investment. However, that just like any other investment, this, you know, is predicated on them actually making money, right? So most of the opportunity zone funds that are online today are from very large institutional developers, and so their risk is probably smaller, but the returns are probably also smaller. But when you're working with a large firm that's done a lot of these developments, you have a smaller risk of them running out of money and not completing the project, right? Or failing an environmental review, or not getting permitting, or whatever, right? All those other things that plague smaller developments that the big guys are going to be aware of and plan around and make sure they're not a problem before they put the shovel in the ground. So at least you'd like to assume, right? So the question about MLPs, I'm not familiar with those as a specific tax strategy. There are some MLPs would usually be master limited partnerships. Those I've rarely seen actually make money. So maybe my clients just aren't good at those. But because they don't usually make money on them, I've not really paid a lot of attention to using those as a tax strategy. So, question: some brokerages provide IRA account checks to allow writing and mailing QCDs to 501c3. I didn't know that. So, but I guess as long as the money's coming directly from the account, the IRA account, and going directly to the charity, then there shouldn't be an issue with that. So, can I max out my the W-2 401k and also contribute to a rental income IRA? I don't know what a rental income IRA is. If so, how much? How can I set up IRA by rental income? If you're talking about self-directed IRA, that where you can buy real estate and rental property in it, that is a very complex topic that I'm not going to be addressing today. So that would be something to research separately. So my employer provides 401k. I'm sorry, if that's not what you were asking about, please clarify your question. So my employer provides 401k, but only to the $27,000 limit. I understand that one can contribute up to $61,000 using after-tax contributions. My employer does not support after-tax 401k contributions beyond the $27,000 limit. What options are available to shelter additional income? Backdoor Roth for $7,000, etc. So yes, the mega backdoor Roth IRA contribution that I mentioned before is what you're talking about. It is dependent on your employer's plan supporting that, though, and not all do. Most of the big tech companies do, but smaller plans probably do not, because there's also issues of being top heavy and that they have to navigate, where a very, very large plan with lots of employees can more easily circumvent those or avoid those issues than a smaller plan. So your options would be limited to your backdoor Roth, like you mentioned, unfortunately. So, there's a comment that IRA distributions to donor advised funds are not QCDs. I believe that's accurate. QCDs need to go directly to the charity. I believe that's accurate too. So thank you for clarifying that if I didn't. For real property bought back before 2000 and held in joint tenancy in California upon death of one spouse, my understanding is the step up in basis applies to just the newly appraised value of the passing spouse's half and not to the entire appraised value of the property. Is that correct? I don't believe it is. And only since 2001, a title designation was created for California named community property with rights to survivorship. This title allows the full value to be stepped up. Do you know if this is true? And if so, recommend retitling one's home and rental properties. I have not been made aware of that limitation. It may exist and I've just never asked, or no one's ever told me about it. But my understanding is that community property is community property regardless of title, and that upon the person's death, all of their property gets this full step up at basis for their surviving spouse. So, the catch for the IRA checks is that they have to clear by year end, not just be mailed. No one's ever made that distinction with me, so that could be true. So, our self-directed IRA custodians fees and account management fees are deductible. Typically, they're paid out of the IRA, so no. Anything that happens inside the IRA would not affect your personal tax return. If you paid them with outside funds, the answer is still no, because as we talked about before, the deduction for those fees has been suspended through 2026. So that's the end of the questions as of right now. So let's go. I think we're almost to the end of my presentation anyway. So we'll just move on. And if you have other questions, please put them in chat. So another thing that people run afoul of, unfortunately, is passive loss limitations, which is where you have a loss from a passive investment. And by statute, all rental income is generally going to be treated as passive, regardless of whether you're actively managing the property or not. So it's going to be limited, and you're generally only allowed to offset income from passive sources without passive loss, right? And so this trips up a lot of people when they buy a real estate property, or they make a large expenditure and they use bonus depreciation, and they're expecting to be able to offset income from other sources with the loss, and that doesn't happen, right? So you never allowed more than $25,000 of net passive loss, and if your income goes above 150, it starts to be limited, and above 175, it goes down to zero. I think is around the limit, right? So for most people, again, because you have to make a decent amount of money in this valley just to be able to afford to live here, most people don't get to take these passive losses unless they have other sources of passive income, right? But a large source of passive losses is depreciation from rental real estate investments, right? And so it can be very hard to have passive income unless you are putting a lot of cash down on these properties, whatever, don't have a lot of operating expenses or ownership expenses. So, but also if you invest in funds or partnerships that invest in real estate or have other businesses, then that can be passive income or losses depending on the source or depending on what they're investing in and whatever. So, so just be aware that it's very difficult to get or very rare to get a meaningful reduction to your tax burden using losses from passive sources. So, question in the chat about, can you apply HSA if you are not able to apply the HSA through your employer? Yes, if you're enrolled in a high deductible health plan that qualifies for HSA. Yes, the HSA is not tied to your employer. That's kind of the whole point. Whereas like a lot of employees have a flexible spending account that they contribute to, where they can put money aside out of their paychecks on a pre-tax basis, but they have to use it or lose it. And if they, switch employers, that money doesn't follow them, right? So the HSA is an independent account that's owned only by you. Oftentimes it's managed through your employer, but it does belong to you individually. It's not tied to your employer. And therefore, if you have a high deductible health plan that qualifies for HSA contributions, you can make a direct contribution to an HSA that you open yourself if your employer does not provide one. So Question, can royalties be filed on Schedule C or is Schedule E required? It depends on what they're for, right? If they're for mineral rights and other things like that, they're going to go on Schedule E. If they are for, if you're like no longer active in writing music or books and you're still getting royalties, that typically would go on Schedule E. If you're still in the business of writing, then generally that's going to be on Schedule C. It's a fact and circumstances thing, however. So each one's going to be a little different. But in general, they're going to go on Schedule E. But sometimes it may be appropriate to go on Schedule C. Of course, it goes on Schedule C. It's subject to self-employment tax as well, as treated as earned income. So there are pluses and minuses to that. So. Question in regards to taking depreciation on rental property when one spouse has passed away. The property is held in joint tenancy and purchased 20 years ago. It's a follow-up question to the last one, sorry. With depreciation taken annually, when a spouse passes and the property appraised soon thereafter, does depreciation continue on the same schedule by the surviving spouse for the remaining 7.5 years, or does depreciation start over for the surviving spouse for the next 20? It resets. It completely resets and starts over at 27.5 years, starting on the date of death of the first spouse. So all of the depreciation, usually if you sold a piece of property that had been depreciated, you have to recapture that depreciation, but all that recapture goes away when the basis resets upon the first death. So I want to have an HSA, but my employer doesn't offer high deductible health plan, but I have to enroll in one of health plans offered by my employer. Is there any way around this that I can continue to have an HSA? I don't believe so, no. The ability to contribute to an HSA is predicated on being enrolled in a high deductible health plan. And if you do not have one of those plans, then you do not qualify to make contributions to an HSA. You can still maintain the account with what's already in it, and you can take money out to reimburse yourself for out-of-pocket expenses incurred since the HSA was open. So, but you do not have the ability to make a contribution to an HSA unless you're in a high deductible health plan. So that's the end of my presentation. We still have about 10 or 15 minutes. This is my contact information. If you have a question, you can always reach out, schedule an appointment. On our website, there's a calendaring link that you can use to schedule a consultation if you have a question. If you're interested in hiring us, we are accepting new clients for tax preparation, tax planning, and accounting if you need it. So that's something that we're happy to discuss with you. If you have a follow-up question to something I discussed here, email is probably the best way to do that. Send me that or to put it in the chat right now. So, but I will remain online until 11 o'clock. That's when the presentation ends. So if there's other questions, even if it's not about something we discussed, please feel free to put it in. If it's something that's I can comment on and is appropriate to answer here, I will do so. Question, how is exempt bond interest treated when both interest and bond premium are reported? Well, if it's exempt, it's exempt. So I think that's, it's not treated any differently. So one thing to be aware of, at least in California, is that if you have a muni bond fund that is not, or a U.S. Treasury bond interest being reported through a mutual fund, that's not at least 50% of the assets for either one, then California does not allow you to exclude any of the interest for that. And in practice, I've never seen a muni bond fund that wasn't specifically for California qualify, because if you find a national muni bond portfolio, they're going to generally have like 3 or 5% of California bonds, along with other states as well. So as a general rule of thumb, if it doesn't have California in the exempt muni bond fund, it's not going to be exempt from California tax. It will be exempt from federal tax though. So, and the same thing applies for interest on U.S. bonds and other federal obligations, generally not subject to California state tax, but only if the fund is at least 50% allocated to those assets. So and for some reason, they know. I don't even know how they know, but they know. Like, and the reason I know this is because my mother-in-law got a letter from the Franchise Tax Board saying, hey, you got interest from these things that don't qualify. And I'm like, how do they even know that? It was all reported by the brokerage. But so I've had to start paying attention to that. Unfortunately, that was an embarrassing lesson. So Oddly, I don't think no one else has ever brought that to me. So, but we do pay attention to that and make sure that we're reporting it correctly from that point forward. So, we replaced the insulation in our attic in 2021. Can you take a credit for it? Yes, subject to the 2021 limits to that credit. And if you didn't claim it on your personal return that you filed, then you can amend it and claim it. So, if one has an HSA and is Medicare beneficiary, can I use my HSA funds to pay for out-of-pocket medical expenses? You can use the funds that are already in there to pay for out-of-pocket medical expenses, yes. But once you're eligible for Medicare, I believe you're no longer allowed to make a contribution to an HSA. So, and then, can a non-working dependent spouse do backdoor Roth IRA? There is a concept they call a spousal IRA, where for a married filing joint couple that if that a non-working spouse can make a contribution to an IRA subject to the normal limits. Yes, and the normal limits are the greater of the annual limits. I'm sorry, the lesser of the annual limits or the amount of earned income. So basically, that's roughly $6,500 for next year. So as long as if there's at least $13,000 of earned income between the two of them, then yes, they could both do a Roth IRA. So, I am sure you do, but want to see if you work with rental properties and income scheduling. Yes, we do. Do I do trader tax status taxes with income going on Schedule C? I personally don't have any currently. I have in the past. I don't have any clients right now that have that status. So doesn't mean I can't. It just means I don't have one right now. So pros and cons of holding ETF versus regular mutual funds inside an IRA. I'm not really aware of the difference between those, because anything that happens inside the IRA would be tax deferred until you take money out. And when you take the money out, it's taxed as ordinary income. So I think the classic benefit of an ETF versus a mutual fund has to do with how they distribute income. I've never actually been very clear because I've never looked into it myself, but that would not make a difference if it's inside an IRA. So I think you would look at, what is the return on it and what are the carrying costs, what are the costs that the manager charges and stuff like that, and make a decision based on that, just like you would in any other context between those two things. So, question about where can we access the recording when it becomes available? It will be available on the YouTube channel for AAII is what I believe. So, and then please confirm that RMD funds or appreciated stock sent directly to a donor advised fund will be treated as reducing gross income. No, they'll reduce taxable income. I'm sorry, you say RMD funds or appreciated stock sent directly to a DAF, but RMD funds, you can't make a qualified charitable contribution to a donor advised fund. So it would have to be money that you took out of your IRA and then contributed, in which case, no, it would not reduce gross income. It would reduce taxable income if you itemize. So muni bond funds issues a statement with the tax statement showing the percentage of muni bonds held in each state and territories. Many of them are doing that now, yes. Edward Jones has been doing that for many years. It's always been very, very helpful to me as a preparer. Lately, I've been starting to see that in like E-Trade and Morgan Stanley statements as well, potentially Schwab as well. It's usually in the back, they'll show what the percentage of each ones are. Otherwise, we have to Google it. So it's nice when they just give you that information. So for the non-working, non-dependent spouse that wants to do backdoor Roth IRA, do they need to first convert existing IRAs and pay tax before doing backdoor Roth IRA? I'm not sure what that is asking. There's no requirement that they do that. If you're asking about doing a tax-free Roth conversion, then we talked briefly about IRA basis earlier, and that would still apply, where they would capture their basis in the IRA over the course of withdrawing the entire amount that's in their IRAs. So as a percentage of the assets that were distributed. So can my spouse apply for backdoor IRA if he has an IRA annuity that he transferred from his former employer? Yes. That's not relevant to what the current year limitations are. So, and then there's a link in the chat for the YouTube channel, or at least a link to the website where they can find the link to the YouTube channel. So in the chat. So I want to set up a general partnership to trade stock. Can you help it to it? What the primary pros and cons to set up general partnership or LLC for stock trading? that is something that we can discuss. I don't handle the legal aspects of forming a partnership. We would talk about the pros and cons and the tax treatment of that, although in general, an LLC and general partnership are going to be taxed the same way. And so the differences would be legal rather than tax, and therefore you'd probably want to discuss it with an attorney. But we can always discuss the tax aspects of that. So I try very hard to stay in my lane, both because I'm not licensed to give legal advice and because I just don't know those topics. And what you don't know that you don't know can sink you pretty quick when it comes to legal matters. So we'll always refer you to an attorney to discuss the legal side of things. We just deal with the taxes. So I just want to clarify that charitable deduction not from IRA do not decrease RMD. Correct. Only a qualified charitable distribution that comes directly from your IRA to the charity. Although there was some discussion in the chat earlier about that sometimes they may send the check to you or they may give you a checkbook to make the qualified charitable distribution, but the funds have to go directly from the retirement account, the IRA, to the charity, in which case they can be excluded from your income for the year. Otherwise, they would be deductible as an itemized deduction. So, and I'm sorry, only qualified charitable distributions reduce the RMD or decrease in RMD, which is what the actual question was. So, are there any restrictions on the types of investments that can be made in an HSA, and what are the tax implications? I'm not familiar with that. I do know that California does not recognize HSAs as a tax advantage type of account. And so it's basically like any other savings or brokerage account to them. So any capital gains, dividends, or interest that is earned on those funds, because some of them do allow you to invest, will be taxable for state purposes, but not for federal purposes. But as for restrictions as to what can be invested, I don't know that answer. I'm sorry. Is there an income limit to apply for backdoor IRA? My spouse has an IRA annuity. Can it still apply for backdoor IRA? Yes. There is no income limit for IRA conversion, which is what a Roth conversion, which is what a backdoor IRA is. And he can still apply for an IRA, a backdoor IRA. Yes. So we are about out of time. I probably have time to answer one more question before we end. So I appreciate everybody joining me here. I hope that you've been able to learn some new things that have been useful to you, or at least open some doors of things that need to be looked into. I am pleased with the way that this went. It went right on time. I presented all the information I wanted to, and we're able to answer all the questions that were asked, I think. So.
Well, Russell, thank you very much for an excellent presentation. I really loved the way you handled the chat and were able to go to the questions quickly. That was very efficient.